Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast. And today I'm going to be talking about how you can add value to vacant properties. Because here's the thing, a vacant property, an empty property in commercial, where there's no tenant, there's no lease, there's no rent coming in, is worth a lot less than a property where there is a tenant in place paying rent under a lease. So today I'm going to explain to you why that is, and how you can use this strategy in your commercial investing to great effect. But first of all, let's talk about how we value commercial properties, because this is the root really of why this is such a great strategy. So unlike residential, when we want to extend a property, make it bigger, make it look better, replace the kitchen, the bathroom, etc., and we value on bricks and mortar, so we look at comparable evidence on bricks and mortar. It doesn't really matter what a commercial property looks like. Now, of course, that is a sweeping statement because tenants want it to be clean and tidy, want it to be white boxed. Different types of commercial, there will be different requirements from different tenants. So there's a big caveat to that. But as a general rule, the way we add value to commercial property is by getting a better lease or putting a lease in place, getting a better tenant and improving the rent as well, because it's all about risk as well. So the way we value commercial property is rent divided by yield. So every time we increase the rent, or even if there's a vacant property and we put rent on it, then we add value. So that's really important to do. So basically one of your asset management goals is to bring as much rent in on a property as possible. But it's the yield that we call the yield, the all risk yield, and it's the multiplier that we apply to the rent to get to the capital value. And we call it the all risks yield because it basically encompasses all the risks of the commercial property, everything from the sector, the economy, the market, down to the location, the configuration and the building fabric, the state of condition of the property, the tenant, the rent and the lease, and lots of other factors as well. So it's basically a bundle of risks, and it's actually an art, not a science. So one of the first things we were taught at university when I was doing my surveying degree was it's an art, not a science, and it very much is. Many of you listening will have experienced down valuations from one valuer and a really good valuation from another. It's very subjective. But with regard to this all risks yield, what a valuer will do is they will look at comparable evidence. Now, in an ideal world, comparables will be all the same as our property, but of course they're not. So what a valuer does is use their experience and their knowledge to adjust the comparables for the property. So for example, if the comparables are in a better location, then in a better specification building, have a better tenant or a worse tenant, then they'll adjust the comparables accordingly, so that basically it's applicable to the property. And of course, that is very subjective. So the very best evidence that we can get on a property is on the property itself. If you can add value on the property and then evidence that to a valuer. So for example, if you've got a vacant property and it only takes 4 weeks to let it, then a valuer will basically look on that really favorably and say, well, there's obviously lots of tenant demand for that property, and they will reduce the risk on it. So we want to be, and obviously the evidence on the lease and the rent as well will be taken into account. So it's really important, really, to be in control of our own destiny if we possibly can. So it's this all risks yield that encompasses all the risks associated with the property, where the vacant property comes in, because at the end of the day, there's no rent coming in if the property is vacant. So that side of our equation is affected. But also there's higher risk because obviously as a landlord, you're paying business rates, you're paying kind of fixed energy costs. You haven't got any money coming in. There's no lease in place. There's no secure income. And therefore that is a more risky asset. So our job as investors is basically give valuers as an easier ride as possible to value the property as high as possible. So a vacant property is worth less than a property that's occupied, because what valuers and lenders especially look at is the lease. And the lease is really important because what commercial leases do, unlike residential leases where the law is very much in the favour of a residential tenant, a commercial lease is not only longer, even if it's only a year, it's obviously longer than a short-haul tenancy, but it also has lots of checks and balances in it, lots of tenant covenants about what they can and can't do in the property. It controls the repair of the property, the payment of rent and other costs. And obviously the lease length is really important, because if you've got a tenant in there for 2, 3, 5, 10, 15 years, whatever, that's certainty of rent, that's certainty of income, and that means lower risk. So lenders and valuers will read leases really carefully. But if there isn't a lease in place, then you could technically say they'll value it on bricks and mortar. But actually what they do is they say, well, how long will it take for this property to get let? And so they'll put a void period in, and then some form of rent free for, to give away to tenants when you're letting, which is very standard practice. And then they'll basically net the rent off for the reduction in the first year. So what they'll do is they'll maybe, if it's a £10,000 a year rent, maybe it'll take 6 months to get everything let. They'll use £5,000 in the first year, and they'll average out over the lease length. So say the lease is 5 years, they'll have 4 years at £10,000, 1 year at £5,000, and therefore the net rent over the 5 years is actually going to be less than the 10,000 because of that lower rent in the first year. So that's the way that they'll tend to look at it. Obviously, they'll be a little bit more technical than that, but that's kind of the broad brush how they'll look at it. So we can take advantage of this in our investing, because vacant properties are worth less than occupied properties. They're going to cost us less. Now, obviously, there's a reason why they cost less. It's because there is risk associated with them. But it's our job as investors to mitigate that risk and to reduce that risk up front as much as possible. So it can be a great strategy to buy a vacant property and look to get it let. So let me tell you some of the ways that you can do this. So first of all, that property may just not be suitable for tenants in the market. Markets move, businesses change their requirements, and sometimes space is too big, too small in the market, or it's not configured properly. And businesses are very sensitive about the type of space they occupy. If it's retail, the location, the shape, the frontage to depth ratio, the configuration. Offices is about location, about specification. Industrial, again, about size, about shape, about yard size, about parking, about access. And lots of other different types of property have different requirements as well. So over time, businesses flex and change their requirements, but commercial property is basically supply and demand. So the reason I advocate niching so much is because if you can niche your strategies in a particular location or for a particular strategy, what you can do is you really get under the skin of where the tenant demand is sitting. And it's our job to provide units that are suitable for the tenant demand in the market, so that we can let our properties really, really quickly and ultimately improve the capital value. That is obviously the name of the game. So we want to make sure that we understand well in advance of buying a property what the demand is. So this is getting under the skin of the market, basically, and obviously what the supply is as well. If you're in a terrace of retail in a city centre, in secondary, tertiary retail, and there's loads of letting boards, everything's vacant, it's looking really derelict, then I would be thinking twice about that. If you want to pivot to a different use, fine, but you really do need to get under the skin of whether that's a good investment or not. On the other hand, if everything's occupied and tenants want to take 10-year leases because there's so much demand in that particular area, I would suggest that's a really good sign that there's lots of tenant demand in that area. So it's our job to find this out. So how do you do that? Well, you want to speak to agents, letting agents, selling agents, and really understand kind of questions to ask, because obviously the quality of our questions to key stakeholders can determine the quality of our answers. So, for example, what is letting really well? Where are you seeing the most tenant demand at the moment? Where are you getting the longest leases? How long are the void periods in different parts of the market? Those kind of questions can really eke out responses. Now, obviously, selling agents have got a vested interest, so you want to be speaking to other commercial agents in a local area to try and determine this. And that's really, really important.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
And sometimes commercial agents won't talk to you, or are just busy. So you want to make sure there's something in it for them. So you want to be, if you're buying a property, then are you going to use them as your letting agent? Tell them that and work with them on it before you buy that property. And also, there's other prop tech. There's prop tech you can use, like Searchland, like Nimbus, like CoStar. You can find out about how long properties have been on the market. You can look at some of the portals like LoopNet, Property Link Estates Gazette, Rightmove Commercial, Zoopla Commercial, and see how much else is on the market in that sector or for that size of space. And that will really, what kind of rents, what kind of lease terms they're offering. And that, again, will give you a rounded look at it. But ultimately, if you've bought in a location, this is where niching comes in. If you've bought in a location and you understand it, you've had a valuation done on it, you will have comparables. You will really start getting under the skin of the market. And that's why niching can actually make your job a lot easier, because you really do become an expert in that particular location. The other thing you can do with commercial is you can pre-let space. Now, not every type of space is suitable, or tenants will do that. But, before you buy, or you might want to do a conditional deal or an option if you can, then you can look at getting tenants in place. So if a property is vacant, you might even have multiple properties that you're buying as part of the investment, then you can look at getting that let before you buy. Now, you've got to be careful here, because quite a lot of tenants won't commit if you haven't actually got a position on the property. So if you can exchange or have an option over it, then obviously they've got some certainty that that's the case. And you can find out tenant requirements through agents. You can find them out through local portals. You can speak to businesses direct, could do business networking. There's a nice website called the Requirement List. You can find that out. And ultimately, another strategy that you can use is sourcing on demand. So if you're very clear about tenant demand, if you can build a relationship, especially with tenant or a group of tenants, then and you become a trusted investment expert, or you become a trusted owner, then they may work with you to buy a property in a particular location, especially if it's very suitable for their requirements. So a few words of warning with that. particular strategy. So number one really is that you'll see requirement lists from especially the big retailers. This strategy is probably better for retail because they publish a lot of requirement lists. You can do it for other sectors, it just takes a bit more work. But not all requirements are made equal. So they will put you'll see people like Lidl and some of the fast food restaurants and stuff, they will have requirements for right across the country, but what they will have is priority locations. So they will have locations where they actually really want to be. And they will have, like, so for example, 2026 requirements. And if you, so whilst they have a requirement list of everywhere, they will have particular locations that they really want to go to first. So if you come up with a location or an investment which is outside of that list that they want for 2026, they may consider it, but they're probably likely to put it on the back burner until a later year because it's not a priority for them. So just be careful in terms of committing to investments because you see that there's a requirement from 2 or 3 brands for a location. You really need to get under the skin of it in terms of exactly what they're looking for and where, but also which year that acquisition target comes into, because sometimes you can be really, and I've been disappointed and let down on this by brands in the past. It's not their fault, but I had a property that there was a coffee shop brand really wanted to go to, but actually it was a much later year requirement, probably 2 years after I bought the property. So it kind of wouldn't work for me as investment at that point. And don't forget as well that a lot of brands, they do have agents acting on their behalf. So you may choose to speak to those agents, but just be careful because obviously if an agent doesn't know about a property and you kind of spill all in the first conversation, you can't blame them for going back to their client and claiming that one. So you need just to be a little bit careful. Are you looking at something in this location? And then you can work from there. So this is all about mitigating risk, obviously, because if you can let before you buy, then that's basically a valuation increase upon purchase. The other thing that you can do is a sale and lease back. So this is where owner occupiers own their own space that they operate from, and they want to sell, but they will take a lease back. Now, you quite often pay a premium for this strategy because obviously you're buying with a tenant in place, but it does give you certainty that there is a lease in place. So that's obviously for you to look at that and work out whether that works for you. Some of the things you need to look out for in that particular strategy is to make sure that obviously their covenant is good, because if you're committing to a longer lease with them, make sure you've got the right lease in place and make sure that that the valuation stacks off that lease and off the rent they're paying, but make sure that they're going to be around in 5-10 years or for however long that lease is. So check their covenant, check the quality of that tenant, check their accounts really, really carefully. So the most usual course of action when you're letting a vacant property would be to bring letting agents in, and you could do a little bit of a beauty parade amongst agents locally. Sometimes you don't have too much of a choice, and sometimes there's a really obvious local agent that is just letting everything, knows the market really well. When you're working with a letting agent, this has to be a partnership. So you must listen to their advice, but also take your own view on things. And just some top tips for you in terms of working with commercial agents. So the first one really is get the advice up front. So when you're asking them about how quickly they could let the property, agents will say, yeah, I can let that property, that's fine. But what you really want is a commitment from them in terms of, you're not going to get it in writing or anything, but, well, how long do you think it would take to let? What kind of lease length do you think I could get? What kind of rent? What kind of tenant do you think I could get in place? Because really the devil is in the detail, and it's the detail that's going to make your valuation good or not so good. So kind of at the outset, understanding what similar types of property they've let locally and what experience they've got of similar types of property and what kind of tenant relationships they've got. Also understanding where they're going to market. So they will always put them the properties on their websites, but not all local agents will put properties on some of the big portals, and so because they simply won't have accounts with them. So don't expect them to do it. If you want them to do it, you must talk to them and say that's what you expect. You also need to look at the adverts, at the particulars. They definitely vary between agents. Sometimes it's like one side of A4. Sometimes they're really nice particulars with lease details, tenancy schedules, floor plans, etc. So you want to be in the latter camp. And if it is a vacant property and maybe it's just looking like a white box, for example, or it isn't looking particularly great, then you might want to put some CGIs, some computer generated images of what it might look when it's occupied. And there's some tips as well when you're doing or agents are doing viewings. If it's an office, don't just have a big pile of desks in the corner. Maybe set them out like an office. It's like these little kind of not tricks, but little tips can actually just get things let much quicker. So for different types of property. And on that note, you may want to do, whilst you don't have to do works to commercial property, so a lot of it is paper-based in terms of your asset management, you may want to have to do that if the property is looking shabby or in poor repair, because a tenant will look at it and go, gosh, that's a lot of work. So that's why we do things like white boxing. So white boxing is when we go in there and basically prepare a unit for a tenant's fit out. It doesn't have to be really expensive. Sometimes it's just a lick of white paint. Sometimes it's replacing the floor, whatever it might be. You need to be careful you don't do too much, because quite often commercial tenants will want to do their own fit out. So you just need to basically have it ready, services ready, etc., ready for them to move in. And sometimes, that can let a lot better than a property where the old tenant stock is still in place and it's looking a bit grubby. Sometimes just a lick of paint is all that's needed. So don't go too over the top, but your letting agent should be able to advise you on what will be needed to let that property, but also use your own common sense in terms of that. And also look at the tenant requirements as well. Also kind of network with local businesses. So you don't get everything from the portals, speak to local businesses. Packages like CoStar can tell you when there's lease expiries locally, and you could approach them direct and say, look, I see your lease is expiring. It's a similar size space. Why don't you come to my unit or whatever else? So the quality of the particulars, also where it is on the pages on the portals. Is it right on the bottom of page 4 or is it right at the top of page 1? That's really important, and there's some tricks that agents can use to renew those. So you need just to make sure that your agent is working with you. And lastly, maybe put some kind of performance related fee in place. Perhaps and make sure that you have regular updates from them, so agree that up front, so that you make sure that you're really on top of what's happening with that unit. Because ultimately, as I said earlier, the quicker you can get that property let, the higher the valuation is going to be, because valuers will have the evidence from the subject property to say that actually that property actually is in demand in the market because it's let really quickly. And lastly, the other thing I just want to leave you with is that in the market at the moment, a lot of valuers are being instructed by lenders to value on vacant possession value, even if there is a lease in place. So if usually in other markets, before we kind of entered this down market, we're in the commercial world, which by the way is leading to loads of opportunities. So it's kind of not a bad thing. But what valuers are being instructed by lenders is to value on vacant possession value, because usually when there's a lease in place, you would value on market value, i.e. you take into account the value of that lease on the property. But when in this market, because the lenders are basically asking valuers to value on vacant possession value because it mitigates their risk. So if that tenant does fail or the unit becomes empty, they valued on vacant possession value anyway. So there's no kind of downside for them. Now, obviously, there is a few tips and tricks that you can use for this. So the first one really is to get this evidence on the property, because if you can prove that you've let that property really quickly, your vacant possession and your market value will be very, very close together, because they won't be deducting too much from the first year's rent. So if you can find properties that will let quickly on good lease terms, that's the name of the game. And obviously you can do some maybe options or exchange delay completion to try and get those pre-lets in place. But the most important thing is to understand the supply and demand really, really well, very intimately before you buy. Do not buy on a wing and a prayer, hoping that you can let a unit. That isn't a strategy. That's just leaving things to chance. And obviously, we want to make sure that our properties are future-proofed, that they hit the trends, that particular location isn't going to go down. So understanding your investing location is really important because the future lettability of that unit is dependent on it. So buying in the right sector, the right location. So this is why I work with my board clients really closely on looking at their niche and working out kind of their investing location so that they're future proofed, not only for now, but for obviously for further down the line into the medium and long term for the unit. So buying a vacant property can be a fantastic strategy because you can buy it cheaper. You can do something to the property to make it more lettable. So I've got clients who are very successfully carving units up. So buying units of maybe this is in kind of Yorkshire area, but buying units of 7,500, 10,000 square feet, and subdivided them into smaller units because the demand is for the smaller units. So what they've done is they've got to know their niche really well. They understand that they can sometimes up to double the rents by actually carving the space up into smaller units because there's much more tenant demand. And so these properties are on the market for quite low prices because there's very little demand for units of that size. But when they carve them up, they're actually almost doubling their valuations because they're increasing the value so much. So we say we do paper-based asset management in commercial, but sometimes we might need works to facilitate that. That might be joining units together. It might be, splitting units out. It might be improving the specification. It might be improving the building fabric. It might be kind of putting some furniture in for viewings. So, it's very much on a horses for courses basis. There's no one rule for this. It will be very much dependent on your niche and the kind of supply and demand in your market. So definitely don't write off, don't be scared of vacant properties. The key is in your research. The key is in building relationships, both with tenants and with local agents, so that you understand the market really, really well. And ultimately, once you've specializing in a niche, you will see the opportunities for vacant properties, but they offer fantastic opportunities for adding value significantly, pretty quickly, as long as you buy in the right location. And, if you can provide a valuer's pack showing that there's evidence on the subject property, you should see significant value increases. You should see yields coming down through yield compression. And you should see, obviously, rents being taken into account or rents increasing as a result. So definitely don't write this one off as a strategy. It's one of the most well-worn strategies in commercial property. And it can be used with a bundle of other measures in terms of, reconfiguring or whatever. But ultimately, what we're looking for in commercial is to let a property so we can get a great lease length, a great tenant paying a great rent. And really, that's the name of the game. So that's your objectives in your commercial investing. So thanks for joining me today. And I look forward to seeing you next time.